Good evening, everyone. This is Wayne, and this is the Valentine's Day version of the Trade Report, February 14th, Wednesday. Well, the market did receive quite the Valentine's Day surprise today in the pre-market, but stay tuned and see how it responded to that gift and whether it accepted it or rejected it. Well, hello again, folks, and again, a happy Valentine's Day to y'all. Well, I was up bright and early this morning because, as you know, if you watched yesterday's trade report video, we had an economic data point this morning that was going to potentially move the markets. Well, that turned out to be an understatement. It totally took the market by storm. So at 5:30 a.m. Pacific time, 8:30 a.m. Eastern time, the Consumer Price Index, otherwise known as the CPI number, was released. And it was too hot. That means that it came in too high, and it indicated that there are some issues associated with the economy that are looking inflationary. And when the market begins to look, when the economy begins to look inflationary, the Fed steps in and raises interest rates. Now, the market has already priced in 3 interest rates, but there's been rumors flying around that it might raise interest rates one more time for a total of 4. And we talked yesterday about how raising interest rates, in effect, reduces the ability for corporations to make money because it increases the cost of doing business. So when the CPI number came in too hot and the inflationary issue rose up, the market went absolutely crazy to the downside. You can see here, and let me just expand this, you can see where the market was just having a grand old time trading in a relatively tight trading range above a resistance level that I had been calling for yesterday to be held above, and that was the 2667 level. And when the number was released, there was an immediate flush to the downside. Now, when that happens, it's very alarming. It's very, very radical. There's an incredible shock and awe dynamic associated with it. Because when that happens, you know that the computers are in charge. There were algorithms waiting for certain levels to be reported. And when those numbers were reported, selling ensued, and a lot of it all at the same time. It was like a flash crash. It was an amazing move. In fact, I believe it was almost a 60-point candle on the S&P futures. The high was 75.25 and the low was 27. So I exaggerated a little bit. It was 48. It was about 48 3/4 points. Still, almost a 50-point candle. That's unbelievable. We flushed 50 points in a matter of, under 15 minutes. And from that point, everyone was extremely concerned about what was going to happen. Were we going to get another push down like we did on Monday and Thursday of last week? Was the market going to lose everything it had gained? Well, buyers stepped in and we started getting bought, started going higher. There's a little bit of tentativeness associated with it. We actually had one bar here that looked like it may not hold up and we might start heading south again. But all of a sudden, wham, we got hit with a pretty decent little bout of buying. And then we ran into a resistance area and bounced off dutifully and then started going back up again and even rose above that resistance area. And when price moves above a resistance area, you start looking at targets. And our first target was 2691 right here. And we found it and came back down, went above it, and just kind of straddled it for about an hour and a half. And then we started going higher. That was the last leg of the day. And we ended up closing at approximately 2,700 after finding a low on the CPI, I'll call it a flash crash, of 2627. So our market, our S&P futures went up 73 points from the CPI low. That is the sign of a very strong market. That's the sign of a market that's had enough downside, that's ready to go higher, and is putting its money where its mouth is, quite literally. Now, there is one more piece of economic data that has to be considered before we say the coast is clear, and that's the bond market. And the bond market has been trading lower consistently, and it traded lower today as well. Now, when bond prices go down, interest rates go higher. So what's even more important than the 30-year bond is the 10-year treasury note. And we talked about this a little bit. And the trigger point for selling in the market as it relates to the 10-year treasury is the 3% yield. Today, the 10-year treasury hit 2.93. So it's only 70 basis points away from hitting that 3% mark. Now, I will say that if today is any indication of what we can expect when a data point causes a move in the market, especially one that causes a move in the market to the downside, and we recover from it, I say bring it on. Let's get it over with. Let's do this thing and get on with the business of the market moving in a way that is conducive to being traded. So many market analysts and fund managers and traders and investors today were saying this market is ready to go higher. And it did. Apple was getting bought. In fact, let's go ahead and just bring this watch list over and I can show you what the market did today. So what we've got is Apple up $3 today. Amazon up another $36.50. Unbelievable. Boeing up $1.69. Caterpillar up $4. Facebook up $6.37. Google up 18.5. Microsoft up just under $1. Home Depot up just under $1. Green across the board. Netflix up 7.5. So actually 7.73. Nvidia up just under 9, PCLN up 20, and the list goes on and on. There were very few red stocks. You can see Tesla was down $1.35, but Tesla is a very special stock. It has some very unique characteristics associated with it. So whatever it does during a given trading day, we just kind of say, okay, well, that's Tesla. But going forward, tomorrow, given the fact that this market made such an incredible showing today, I have to believe that the Asian markets and the European markets in the extended session overnight tonight will be inspired. They will say, the US regular session really came alive even after a really hot economic data point. And typically, like follows like in the financial markets, meaning I believe the Asian markets and the European markets will probably go higher, and then we will open higher and in all likelihood continue higher. Now, we can't just keep going higher forever, but at the same time, we have stocks and we have market conditions that are extremely favorable in terms of valuations and value in general than we did before this pullback occurred. Now, this was more than a pullback. This was technically a correction. So we have to treat this with a level of seriousness. And the one last piece of this puzzle that needs to be looked at in a somewhat serious manner, let me bring my my watch list back, is the VIX. Now, we looked at the VIX last night, and I described a little bit about how the VIX works and how, we've got the volatility being measured in a way that is, in essence, being defined by the level of concern and fear that is being felt in the financial markets as it relates to the most recent move down. But you can see as the VIX moved down today and prices went up, we are really collapsing on the VIX. The VIX spiked up here at 50.30, had a little bit of a down move, moved up again, moved down, and now we're really coming down. So we have a 19 print in the VIX. If we can get down to 15 or 16, that's pretty much an all clear at that point. It doesn't mean we don't ever go down again. It doesn't mean that we don't have issues that may create moves to the downside. But the type of move that we experienced last week, you can read all sorts of articles about it, but there's a lot of evidence pointing to the fact that volatility was being treated as an asset class, and there are many derivatives in the financial markets that are associated with volatility, and there was such a huge trade in it that it unwound. And when it unwound, it really unwound, and it took the whole market with it. So that's the predominant reason that the market went down so far and volatility spiked up so high last week. But again, we have that 10-year yield that is still on the radar screen, basically. And that CPI number is now behind us. So we are really basically good to go to the next level. And it's really time for us to begin doing the work of the market that we left behind about almost 2 weeks ago now and begin moving higher. There really is no reason not to. Our economy is very strong. The key is to keep it under control so that we don't have inflation. And that's why the Fed steps in and introduces rate hikes. Because when interest rates rise, the economy is thwarted from being inflated. So we've got some balancing that needs to be done, and it will do it. I believe the market has factored that in, has priced that in, and I think we go higher. We're at a level that when's the last time that we saw this level? Let's take a look at as a matter of fact, let's take a look at this. I want to take a look at the Fibonacci chart of the SPX. And the last time we were at this level was, oh, looky there, the first of the year. So basically, we are right back where we started on January 2nd of this year. Wow. All right, there's something somewhat poetic about that. So basically, everything that happened between the very first trading day of 2018 and today, which happens to be February 14th, Valentine's Day, has come back to parity. We are basically right back where we started. Now, does that mean we're going to go back up again? For sure. I think we'll go back up a little bit, but let me just one last time draw your attention to this area that I'm looking at that is very important. And that's this confluence. Let me get see if I can get this. It's not working. And I don't know why. Anyway, this area right here is a confluence. Sorry, this area right here, where this red line and this green line cross, is a very powerful area of resistance. So that comes in at 27.27. If we get through that, or shall I say when we get through that, that will in essence bring us to that place where the all clear can be sounded. So until that time comes, we do have a little bit of work that needs to be done, of course. So we'll be taking it a day at a time. We've got about 27, 28 points to go before we get to that confluence, and we'll see how it plays out. Again, watching the overnight markets for the Europe and Asia sessions to trade higher. That should lead us into a higher opening tomorrow, and we'll see if we can hang on to those gains. All right, folks. So with that, I bid you good night and good trading.